Welcome students. So in the process of learning about the time value of money, now we'll take the discussion forward, and as I told you that under this process of time value of money we will learn about the process of that compounding and discounting. So under the compounding we calculate the future value of a single amount or a multiple amounts, and under the discounting we calculate the discounted value of a single amount or a multiple amounts. Means discounting means any cash inflow which is going to occur in a subsequent period of time, in a future period of time, and we want to compare it with today's amount of the cash outflow. So we want to see that cash flow coming in the subsequent years and cash flow coming in the present time. Cash outflow is going out in the present time. Are these two amounts equal? Maybe the value of the discounted value of the cash inflows is more than the total existing value of the cash outflows. So in the process of learning about the compounding, or maybe that what is going to the future value of some amount, it can be a single amount, it can be a multiple amounts, or it can be annuity, it can be perpetuity or anything. So how much is going to be the future value of a single amount? So for that purpose we are going to take the help of the process of compounding. And for example, in this case we are going to understand the process of future value of a single amount with the help of a very simple example. And that example is, for example, we have a principal amount here which we gave to the bank, and this amount is, for example, 1000 rupees, and we deposited this for a period of 3 years, right? With the bank we deposited it in the fixed deposit, and a bank promised us that I'll be paid interest rate of the 10%, that is 0.10, 10% rate of interest. At the 10% rate of interest I deposited my 1000 rupees for a period of 3 years in the bank. So how much the value of this future value of this single amount of the 1000 would be at the end of the third year? So this is going to be the value, and my 1000 is going to be 1331 at the end of the third year. Now the $1,000,000 question is whether this 1331 is equal to the 1000 of present time or not. So we will have to see that what is the inflation rate. If the inflation rate is equal to the discount rate, then I think the value is going to remain the same. But if the inflation rate is going to be very high, then certainly the value is not going to remain the same. Rather, the discounted value of this cash flow, 1331, will be lesser as against the total value of the present value of the cash outflow of the 1000 rupees. But for the simple, maybe to understand the future value of a single amount, we are going to get to know that I am depositing this money 1000 in the bank, and 10% I am going to get the return. So in the first year, at the end of the first year, how much I am going to get? My 1000 rupee will become 1100 rupees, and in the second year my 1100 rupees after earning an interest of the 110 will become the total value of the 1210. And in the third year, the principal being 1210 in the beginning, and interest being, that is 121, 10% of the 1210 rupees. So the total amount, closing balance, or the total amount in my fixed deposits will be 1331, right? So this way I can easily calculate, and this is basically the compound interest. We are not taking the interest back every year. It's not a simple interest. Rather, this investment is earning interest on the interest. So any investment when earns interest on interest, that is called as the compounding process, and that interest is called as a compound interest. So this is not your 1000 that you deposit 1000 rupees at the simple interest of 10% for a period of 3 years, then the value would be something much less. But since we are calculating it on the basis of the compound interest, and we are doing the annual compounding here, because we are not taking the interest back annually, so it means whatever that interest is being earned by this investment, that is also being reinvested back into the principal amount, being added back into the principal amount. So the total, this 1000 has become 1331. So now I have to make sure that after 3 years, this money being paid back to me by the bank, that is 1331, is equal to the 1000 rupee of today which I deposited in the bank today or not. And for that purpose you have to discount this amount, this cash flow. So first year's cash flow 1000, 1000 you gave in the beginning of the year, and 1000 you got this at the end of the year. So you have to compound it for the 1 year, you have to compound it for the 2 years, you have to compound it for the 3 years. So in the first year's cash flow would be 1000, second year's cash inflow would be 1100, and the third year's cash flow would be 1331. So these three cash flows have to be discounted at something which is called as the weighted average cost of capital. So, and then I have to find out that sum total of the discounted value of this 1000, 1100 and 1331, sum total of these three values is equal to 1000 rupees or not. If it is equal to 1000 rupees, fine. If it is not equal to the 1000 rupees, then it means it's a cause of concerns, especially when it is less than 1000 rupees. So future value of a single amount can be easily calculated, but that future value is equal to the present value of that outflow or not, that we have to understand very carefully, because my purpose is giving this money to the bank is, my purpose of giving this 1000 rupees to the bank is, minimum objective is preserving the value of 1000 being 1000 after 3 years even. If I keep it in my pocket as a cash, if I keep at my house as a cash, I don't make any investment anywhere outside, neither in the bank, nor in the bond market, nor in the business, nor in the stock market. So what will happen? Your 1000, because the inflation will become 900, 800, and a time will come when the 1000 will become almost zero. You will not be able to buy any goods and services for 1000 rupees after maybe 4 or 5 years, because inflation is growing, value of money is going down, and because of that inflation, because of the time value of money, there is always a factor, inflation, which creates a problem, reduces the value of the money, and for that purpose you have to keep it preserved. So I am giving it to the bank because I don't want to take any risk, right? My objective is the rate of return bank is going to give it to me is at par with the inflation, right? So on the one side, my value of my money is going to go down because of inflation, but the other side, value of my money is also going to increase because of the interest I am going to earn, and that to a compound interest at the rate of 10%. So it means my money is safe, the value of my money is safe, it is preserved, and that is my ultimate objective. Now, if your objective is to preserve the money, you may become totally risk averse, and you may give this money to the bank, and bank may give you the rate of interest at par with the inflation, and it can safeguard your money. But if you are not satisfied with this only preservance of the money, or maybe keeping the value of the money same, in that case you will look for the other investment avenues. Probably you can go to the bond market. Bond market is giving you the rate of interest more than the bank is giving to you. So there may be a difference, that inflation is 5% and the return from the bond market is 7% without any kind of taxes. I am not considering any kind of the taxes. There is a difference of the 2% between the return and the inflation rate. So certainly the final value, the closing value after 3 years of that investment, because of that interest of 7%, would be more than the principal amount which we gave to that investment avenue while we subscribe to those bonds. But here the tax comes to play the role. So certainly, for example, if you are paying 30% of the tax, so it means close to 2 rupees will be paid, more than 2 rupees I think. 2 rupees 10 paisa you will be ending up paying against that 7%. You will be paying maybe 2 rupees if you are earning 7 rupees as interest, right? So 2 rupees 10 paisa you will be paying as a tax to the government. So maybe your inflation is 5%, your return finally becomes 4 rupees and 90 paisa. So value of your money will go down. So you have to, your minimum objective has to be keep the value of money safe, and for this purpose we calculate like this. Simplest example we are taking here for calculating the future value of a single amount. So we deposited a single amount with the bank. Bank is going to give us 10% of the return. Other way around, you think about, you invested this 1000 rupees in your project, in your investment venture. It can be 1000, it can be 10,000, 10 lakhs, 10 crores, or any amount. Now you have to compare it, that if I give this money to the bank, how much return I am going to get, and after 3 years how much my money is going to be. On the other side, you invest this money into your venture, and after 3 years you have to see how much money this money goes up to or grows, and how much it becomes. So is there any kind of difference, significant difference between the return I am getting from the bank by taking zero risk and the return I am getting from my business? But I am taking every kind of the risk, every kind of the uncertainties, and because of those uncertainties, all kind of the risk I am going to take. So is it worth making investment into this venture or not? Even you can compare not with the bank. Bank is the maybe safest mode or maybe the lowest return you are getting from the bank. You can compare it with your investment with the bond market, with the stock market, and with the business, or maybe with the real estate also. Because in the bond market, you are not going to take any risk because it's a fixed income security. In the stock market, you are going to take a risk because of the ups and downs of the market. But comparatively, risk would be lesser because somebody else is managing your money, and you are investing your money into the companies which are already sustaining in the market for a number of years, and it's a stable kind of a investment avenue, right? Even in the real estate also, because the real estate, there is a kind of a risk keeping your assets safe, but still by taking that much amount of the risk, the return is also quite significant and quite good. But in your own venture, you take the highest amount of the risk, so the return should also be highest as compared to the any other revenue of investment, whether it's a bank, whether it is the bond market, whether it is the stock market, or it's a real estate. You have to compare like this. You have to start with a small amount and see here that how much I'm giving today, how much I'm getting after 3 years, what is the rate of return, and is this growth going to preserve the value of my money or not. And you can use this, we have done in a very lengthier way. This is a very complex and very lengthier way. Practically, you are not going to do like this. You can use the simple formula here. Present value is the 1000 rupees and into 1 plus R power n. R is basically the discount rate, which is basically you call it as the cost of capital, cost of your capital, right? Expected cost of your capital or weighted average cost of the capital. Cost of capital means how much return you expect on your investment in any avenue. For example, bank is giving you 5%. You are not happy with that. You say the return of my investment or the cost of my capital is not 5%, rather it is 15%. You try to go to bond market, but bond market is also giving you 7%. You try to go to the stock market, but the stock market is also going to give you sometime 15%, sometime 5%, sometime 10%. So on an average, it works out as 9%. You are not happy with that. You go to the real estate market, so real estate market is also going to give you somewhere 12-13% of the return, whereas you feel the cost of your capital is 15%, which is possible only by investing your surplus resources or your investment into a venture, into a business, into a project. And for that purpose, you have to make a comparison, and for that purpose, you have to invest this 1000 rupees in the business, and you have to expect a rate of return. The cost of capital, we call it as a weighted average cost of capital R. So you have to discount, or maybe at this point you have to multiply present value, you have to multiply by this 1 plus R, and number of years is the power n. So by using this simple model, you can get to know present value is 1000 into 1 plus R is 0.10 and power is 3. So if you give these values, if you put these values in this, finally you will get this value very easily, which will be 1331. So this is a detailed process for the sake of understanding, but we use the shortcut formulas, and these days in the computers these formulas are already existing. So when you go to any investment firm or any bank or any maybe avenue of investment for borrowing money or investing money, both ways. So you tell them and they ask you how much you are going to borrow from us or how much you are going to invest with us, and for how much period of time, and how much interest they give or charge. So putting all these things into their computers, they immediately get that if you are going to invest a certain sum with the investment company, so they are going to tell you after 5 years we will return you this much. And if you are going to borrow, then they will also tell you that after 5 years, 10 years or 20 or 30 years, you have to pay total back this much to us. So how they are going to calculate? Because they are the inbuilt formulas in the computers these days. So we don't need to go for all these detailed manual calculations. This is only for the purpose of our understanding. So practically we have to use this inbuilt formulas in the computers, and we have to get the value of certain amount, maybe the present value or the future value within no time. Then we go for the next thing. So here are the values already calculated. You don't need to. These are some tables. If you look for any book on the investment management or financial management, at the end of that book, these tables are already appended. Or you can search on the net also, that is a future value tables, future value for a single amount for a annuity, present value of a single amount and present value of an annuity tables. So all these 4 or 5 tables are easily available. So in these tables, on the one side means you are given these two things. On the one side this is N, on the other side this is R. R is basically the discount rate or maybe the cost of your capital discount rate, and N is the number of years, right. So some value, some factors are available here. So if you want to find out that how much your 1000 would be at the rate of 6% after the 2 years period of time, so if you multiply that 1000 with 1.124, this value, factor value, so you will find out that your 1000 at the rate of 6% rate of interest after 2 years will become 1124, right. And after say 4 years it will become 1262, after 6 years it will become 1419, and after 8 years it will become 1594, and after 10 years it will become 1791, provided the rate of interest is 6% and rate of this interest is 6%, number of years are given to you. So on the one side you are given the rate of return R, and on this side, vertical side, you are given the number of years, and on the horizontal say axis you are given the percentages. So you can look at for this factor for a certain investment, multiply the investment with the factor, so you will get easily, you will get the future value of that investment, and don't need to go for long calculations. Rather, these are the readily available tables are there. You can get the factors from these tables, multiplication factors from the tables, and you can easily find out the future value of a certain amount. Then there is a simple concept of doubling period. Doubling period is that it's basically not a very finest estimate of any kind of calculations, but yes, it gives you the quick estimates, that quick outcomes, that how much in how many years your investment is going to go double, right. So if you know the interest rates, if you know the return rates in your business also, in your project also, in your venture also, if you can estimate, if you can predict the rate of return, which you call it as a interest rate here, right. So under the rule of 72, you can easily, what you do is you have to divide the 72 by that expected rate of return or rate of interest, and you will find out that would be the doubling period of your investment. For example, in this case we have assumed that rate of return is 15%, right. If you divide 72 by 15%, any investment which you are going to make in the venture where the rate of return is 15% is going to become double in 4.8 years, close to 5 years. This investment is going to double if the rate of return is 15%. As I told you, that cost of your capital is 15%, which is not available in the banks, which is not available in the bond market, which is not available in the stock market, and neither it's available in the real estate market. It's only available in your venture, in your business. If you go into for making this investment, only then this return is available of the 15%. So if you are having the return on your investment 15%, it means by using the rule of 72, it's going to become double in close to 5 years, in the 4.8 years. And there is a more accurate rule, which is the rule of 69, right. 72, rule of 72 is a little older. So the latest rule is rule of 69. So you can use this rule of 69 also, and you can calculate in how much time your investment is going to go double given the certain interest rate, and this more precise estimate as compared to the rule of 72. So in this case the formula is, the model is 0.35 plus 69 divided by the interest rate. 0.35 plus 69 divided by the interest rate, and for example the interest rate is 15%, and if you put this 15% into this, so it is going to be what, 0.35 plus 69 divided by the rate of interest of 15. So now you can find out that your investment is going to go double under the rule of 69 in 4.95 years. So this is more precise estimate as compared to the rule of 72. Going into any other kind of nitty-gritties, you can use these two rules. Mostly you can use the rule of 69, and if you know the rate of return available from your investment or from your venture, then you can easily find out that in how much time your investment is going to go double, provided the rate of return is exactly known to you, or maybe approximately closer to the correct rate is known to you. Then only you can find out that what is going to happen to your investment, in how much time it's going to go double. And for example, if it is going to go double in 5 years, no other avenue is going to give you this much of the growth to your investment. This is the best option to go for this kind of the project, this kind of the venture. Make investment, grow with that, make your own company and become your own king rather than working for somebody else, right? So rule of say doubling period is here. So rule of 72 and 69 is here. Similarly, we have, as we saw that future value interest factor table, right? We have seen this FVIF, future value interest factor table for certain given rate of return as well as the number of years. Similarly, we have already the present value interest factor table also. So the model is little different. Now it becomes a reciprocal in the reciprocal form, and the present value is replaced by the future value. So earlier the future value was here, it was the future value, right, and here it was the present value. Now what is happening, the present value is going there, this side, and future value is coming to this side. So now in this case, for calculating the present value of your cash flows, you have to calculate the future value first, and future value, if you are multiplying by 1 divided by 1 plus r power n, the reciprocal of the previous model, so you are going to find out that the present value of the say single amount, present value of a single amount which is going to be earned in the future, not today. Cash outflow is today, inflow is going to be earned in future, maybe after 1 year, 2 year, 3 years, a single amount. So rather than following any detailed calculations or any detailed formulas, you can use this ready-made table. On the one side you are given the rate of return, right, 6, 8, 10, 12, 14. On this side vertical axis you are given the n number of years. So for example, any investment if you want to take, say you make a, say the present value of the investment is 1000. So how much it is going to be if you want to calculate the present value of a single amount which is going to be earned in future. So what is, if you know the future value, how much is going to be by applying this model or maybe multiplying by this factor. For example, 1000. If you are saying the 1000 you are going to earn in future, you are investing 800 rupees today, and that 800 rupee after a year or after 2 years will give you 1000 rupees. So you can simply find out what would be the value of that 1000 coming to you against that 800 rupees coming to you after 2 years as a future value of that 800, the earning of 200s, right? Maybe 800 will become 1000 rupees, but 1000 rupee will come to you after 1 year. So what would be the present value of that? So you will multiply the 1000 with 0.890, and you can easily find out that 1000 after is earned after 2 years will, the value of that in the present times would be 890 rupees, right? So you invested how much? 800, right? After 2 years you got 1000, but the present value of that 1000 is 890. So you call it as the difference between this is going to be 90 and this difference is going to be positive difference. So it means you have earned something on your investment, though the discount factor was different. But even after discounting those future values, the net result is more than what we invested. So investment was 800 rupees, return was 1000 rupees, discounted value of that 1000 rupee was 890 rupees. So net difference between the cash outflow 800 rupees and discounted value of the inflow 890 rupees. So net difference is 90, which is a positive difference, and we have means earned surplus, or maybe we have increased our investment, the value of investment, and this is a good investment option. But for example, that 1000 rupees comes to you after 4 years. You invested 800 rupees today, and after 4 years that investment option is going to return you 1000 rupees. In that case you have to multiply it by this factor, and this value will become how much? This value will become against 800 rupees, it will become 792 rupees. So there is a net difference of minus 8. So this is a loss making proposition because 800 is 800, right? And that 1000 coming after 4 years is 792. So there is a net loss of the 8 rupees. So you should not make that investment into that investment avenue. It's better if it is going to give you 1000 rupees after 2 years, because the net result is positive and significant difference is there between the outflows and the present value of the inflows. So by using these tables, these ready-made tables these days, the factor values, simply you can multiply with the present value or the future value, and you can get to know the present value of a single amount and the future value of a single amount. One important difference here is that if you see here, when you see the present value table, of a single amount, you will find all these values are less than 1, right? That is, first value is 0.890, 0.792, 0.705, 0.626, 0.558, 0.497, all that. They are less than 1. And if you compare this table value with the future value table, these all values are more than 1, right? The reason is that in the one case you're going to compound the value of the investment, and this more than 1, the factor being more than 1 is the magic of compounding, right? So you are going to calculate the future value of a maybe a single amount, right? So when you are going to calculate the future value, naturally future value has to be more than the present value in the absolute forms, not in the discounted forms. So your investment principal amount plus interest, so it's going to be more than 1. So here the table value is more than 1, all the factor value is more than 1. But when you are going to discount it, so the discounted values are less than 1, because you are going to calculate the present value of a future amount. In this table, you are going to calculate the future value of a certain amount, future value of a single amount. So future value of a single amount is going to be more than the present amount or present value in the absolute form, not in the discounted form, because this is going to add something in the form of interest. So principal amount plus interest would be more than 1. But if you discount this cash flow against the cost of capital, maybe the discounted value would become, means the discounted value would be less than the present value. But here this table is going to give you the value which is more than 1, because you are going to calculate the future value of a present amount, and in this case it is less than, because you are going to calculate the present value of a future cash flows. So present value of the future cash flows is going to be less than that amount which you are going to earn in the future. If you want to compare those future earnings with the today's value, certainly that's going to be less. So the factors, all the factors are here having a value which is less than 1. So future values tables will have the more than 1 factor, means the value of the factors would be more than 1, whereas in the present value tables the value of the multiplication factors would be less than 1. This is because of the, say, compounding and discounting of the certain values or certain investments. Now we can calculate here, for example, before we stop here for the further discussion, we can see here present value of an uneven series. So we have calculated the present value of a different amounts, we can calculate the present values. So when you are going to talk about the present value of a single amount, so we are going to start with calculating the present value of the uneven series, and here maybe these are the cash flows. Uneven means we have the multiple years here, 1 to 8 years, 1, 2, 3, 4, 5, 6, 7, 8 years, and cash flows are, means these are the 8 cash flows available here, and we have here now the factors we have taken from the table. They are the present value factors which are always less than 1, because we are going to calculate the present value of the future cash flows, and present value of any future cash flows would be less than 1. So we are going to multiply with this factor. So these are the uneven series. This is not a single value. This is not a, you're going to call it as an annuity. This is a different values. So in the first year the cash flow is 1000, 2000, 2000, 3000. Multiplying it with the present value interest factor means the cost of capital is 12%, and a number of years is given to us. So first cash flow is coming to us is A, this is 1000, A1, A2 is the 2000, A3 will be the 2000, A4 will be the 3000, A1, A2, A3, A4, A5. Then it's going to A6, A7 and A8. So AN you can call it as, right? And finally this model becomes like this, that is the sigma n is equal to cash flow for the as a number of years signified by T divided by 1 plus R power T. So this over the number of 8 years, these cash flows are there with us. So A's are going to signify the cash flows over the subsequent number of years. PVFI is the present value interest factor which we have taken from the table directly, and we have assumed that our weighted average cost of capital is 12%. Number of years is given to us. For example, you will discount this cash flow only for 1 year, and the discount factor is, that is 0.893, because only 1 year. So 1000, 12%. If you see in the table the value, the factor would be available 0.893. This you are going to discount for 2 years. So same 2000 and at the rate of 12%, and for the 2 years. So, if you look for the value in the table, you will find the factor 0.797, multiplying it by the 2000, this value will come. So, you are going to calculate the present value of individual cash flows, and sum total of these values will become 13,376. This is the present value of a cash flow stream, which is though uneven, but these cash flows are going to be available with the investor of a project, the entrepreneur of a project. This will be the inflow coming from that investment, from that venture. And over the years, if you see here, how much is the absolute value of these inflows? This is 3, 5, 8, 11, 15, 19 and plus 24. So, this is going to be 24,000, whereas the discounted value 24,000 rupees, right? 24,000 rupees we are going to earn the discounted value of that over the number of years for the given weighted average cost of capital, and the rate of interest is 13,376. So, it means almost is going to be close to approximately half of this absolute value. So, this is the real, in the real sense, going to communicate it to us that we should not take the value of the future cash flows in its face value. Rather, we should discount it over the period of time to calculate the present value of the money, and finally we should try to find out that what would be the discounted value of the future cash flows and compare that with the present value of the cash outflows, and then try to find out the difference, which difference we call it as the present value, or we call it as the NPV, net present value, right? So, the decision criteria is that NPV means the net present value, the difference between the value means discounted value of the cash outflows and inflows should be minimum 0. If it is more than 0, right, it is going to be very good. But if it is less than 0, negative, it means the present value of the future cash flows is lesser than the present value of the present cash outflows. In that case, we should not make any investment into this kind of the ventures. So, with this discussion, we are stopping here at the moment for the time value of money, and remaining discussion on the subsequent concepts, or maybe the remaining concepts with regard to this particular broad concept of the time value of money, we will discuss in the next class. Till then, thank you very much.